Hi, I'm Bill Spaulding. Welcome to WCS Money Tutorials. Did you ever think about trading stocks as a business? Losses are treated as business losses, which can be used to offset other income, including employment income. All expenses that are ordinary and necessary for the business are deductible, including a home office, computers and other equipment, software, investment services, subscriptions, and educational expenses. A huge tax advantage is that you save in self-employment taxes. As far as I know, I do not know of any other business where you do not have to pay self-employment tax on self-employment income. I will explain why this is so later. The self-employed must pay both employer and employee portion of the tax, which comes out to 15.3%. However, you can deduct the employer portion of the tax, which means that the actual self-employment tax rate comes out to about 14.13%. For employees, the Social Security contribution to benefit base tops out at $160,000 in 2023, but self-employed people must first subtract the employer portion from their income to determine their wages subject to self-employment tax, which means the Social Security tax applies to all income up to $173,470. Above that income, only the Medicare tax applies, which, based on the same reasoning, comes out to 2.68%. The IRS classifies stock market participants into three types: dealers, traders, and investors. Dealers trade on behalf of other customers. Traders and investors trade on their own behalf rather than on behalf of their customers. However, the crucial distinction between traders and investors, according to the IRS, is that traders profit from short-term price swings. Investors profit from dividends, interest, and capital appreciation. For investors, the deduction of investment expenses is extremely limited. Direct expenses, such as commissions for buying and selling, are fully deductible because they adjust the tax basis of the property, but no other expense is fully deductible. Interest is deductible only if you itemize. Even if you do itemize, as you can see from this example, the deduction is limited. And if you don't itemize, and most people don't, investment interest cannot be deducted at all. Other annual investment expenses are not deductible until 2026 due to the suspension of miscellaneous itemized costs exceeding the 2% of adjusted gross income floor, enacted by the Tax Cuts and Jobs Act passed at the end of 2017. To be considered a trader by the IRS, you must profit from short-term price swings, not from dividends, interest, or capital appreciation. Your activity must be substantial, and you must carry on the activity with continuity and regularity. The following facts and circumstances should be considered in determining if your activity is a securities trading business: typical holding periods for your securities, frequency and dollar amount of your trades, the extent to which you pursue the activity to produce income for a livelihood, and the amount of time devoted to the activity. You must use a taxable account. You may be a trader in some securities and hold other securities for investment. The special rules for traders don't apply to those securities held for investment. A trader must keep detailed records to distinguish the securities held for investment from the securities in the trading business by holding them in separate brokerage accounts. Trading must be your primary occupation and a major source of income. Profiting from short-term price swings is the only activity that the IRS will accept for a professional trader. It is not enough that only some of your trades are short-term, so you will not have any long-term capital gains, and it is imperative that you hold your business investments in a separate brokerage account from your personal investments. A major risk to establishing professional trader status is that the terms trader and investor are not defined by the tax code. Instead, the definitions are based on IRS guidance and on court decisions. Traders may choose mark-to-market accounting, or they could continue with regular investment tax treatment. Accounting method does not determine trader status. However, you must choose mark-to-market if you want to avoid the $3,000 capital loss limitation that would allow you to offset losses to other forms of income, such as employment income, and to avoid wash sale rules. Gains and losses are ordinary gains and losses, but this is not a disadvantage because long-term trades are not allowed. Tracking historical cost basis is unnecessary, since securities acquire a new tax basis at the beginning of each year. Also, the mark-to-market election does not apply to securities held for investment. Choosing the mark-to-market election will make the wash sale rules irrelevant. A wash sale occurs when you sell securities to claim a loss, but then you buy substantially identical securities within the wash sale period. The wash sale rule disallows the claiming of losses for securities in a wash sale. Since all sales are marked to market at the end of the year, the wash sale rules are not relevant. Trades are reported on Form 4797, Sales of Business Property. In Part 2. Information for the mark-to-market election can be found in the instructions for Form 4797. The instructions also show how your transactions must be reported. Section 475 of the Tax Code permits mark-to-market accounting for eligible taxpayers. The securities you hold for investment and in your trader account, if you do not choose mark-to-market accounting, are reported on Form 8949 and Schedule D, not Form 4797. There are several disadvantages to MTM accounting. There is no long-term capital gains, nor is there any deferment of taxes on unrealized gains. Revoking the MTM election must be made on the tax return for the year prior to when the election applies. To make an election, you must attach a copy of a statement to your original federal income tax return for the election year. The required statement must describe the election being made, the first taxable year for which the election is effective, and the trade or business for which the election is made. Since the mark-to-market election requires the change of the accounting method for reporting gains and losses, you must file Form 3115. This election may only be revoked by receiving permission from the IRS by refiling Form 3115 to change the accounting method and paying a fee for the change. There are two codes to use when changing your accounting method. These codes are found in the instructions for Form 3115. Use Code 64 to elect mark-to-market accounting. Use Code 218 to revoke the election. The statement must be filed no later than the due date of the original federal income tax return for the year immediately preceding the election year, by attaching it to either Form 1040 or, if applicable, to a request for an extension of time to file that return. No late elections are allowed. The election cannot apply to a previous year. For example, to be treated as a professional trader for 2023, your statement must be attached to your 2022 tax return or to your 2022 Form 4868 application for automatic extension of time to file. Now I need to explain an unusual feature with a professional trader status, especially in the way that income and expenses are reported. Ordinarily, if you have a business, then both income and expenses are reported on Schedule C. However, professional traders only have income from trading securities. If regular accounting is used, then trading income must be reported on Form 8949. Then the income is transferred to Schedule D. From Schedule D, the income is then transferred to Form 1040. If mark-to-market accounting is chosen, then income is reported in Part 2 on Form 4797. Then the income is transferred to Schedule 1 of Form 1040. Income is totaled on line 10. Then the income is transferred to line 8 on Form 1040. Income is never transferred to Schedule C. However, you could only list business expenses on Schedule C, which means Schedule C will always show a loss. Self-employment tax is calculated from the net profit from Schedule C. So, if there is no net profit, then there is no self-employment tax. The IRS provides more information in topic number 429, available on their website at irs.gov. Links for more information are provided in the description to this video. I do want to emphasize the risks for trader status. There is no bright legal line that distinguishes a professional trader from an investor. Audit risk may be higher. If you lose trader status, you may be liable for substantial back taxes, interest, and other penalties. So consult with a professional tax advisor. Be sure to select a tax professional who has experience with trader status to ensure that you are complying with the law. A professional should be able to answer any detailed questions that you may have, but understand that that is no guarantee that the advice is correct. However, penalties may be avoided or lessened if you relied on the advice of a tax professional. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.